thank you for clicking into this webcast about the DNB Navigator Fund. DNB Navigator is a sector fund within the shipping and all services sector. I'm here with the fund's manager, Mr. Rune Kaland. And Rune, this year has been a year with quite high volatility in the fund returns. It's reason to suspect that that volatility comes from the different subsectors of the fund. What is to be said in general about the different subsectors so far this year?
Yes, it's very much due to the subsectors. And if you start off with the oil service and seismic, which is a sector we have quite a bit of exposure in, the outlook is really good. There was a large convention in Las Vegas last week, all the major companies present, and they expressed outlook of an increase in prices rates of 10 to 15%. We also see now multi-year contracts, which is quite rare in the seismic market, which indicates that the oil companies think it's going to be pretty tight. We also like the valuation of the seismic companies still. On the drilling side, it's a blue sky scenario. It's very good rates, peaked probably, but at a very high level. It's many years, 3 to 5 years contracts, and the new building price is still very low. But what we can see there is that this is now coming into the valuation of the companies, and if it has been for still pretty good dividend in these companies and also a kind of defensive character of this sector, we probably have been reducing that exposure a bit more than we have done so far. On the subsea construction, a lot of contracts, a lot of activity, probably be a shortage of equipment and services going forward, but Technip has been stealing a lot of the new contracts. We have been playing a horse called Subsea 7, probably get their share eventually, and the valuation of that company is good, so we hold on to it. Engineering and the big conglomerates, basically the US, looking good on the engineering side. Valuations getting a little rich. Opposite on the big conglomerates, valuation is good. Hurt by some overcapacity in North America, basically. But some of these companies had not that much exposure in North America. So we like some of these companies very well and have been increasing our exposure lately. On the shipping side, we haven't seen so much change in our view lately. The dry cargo and tanker segments still very, very bad. We believe maybe dry cargo can be something to look at in some time, moving up on the radar screen a little, but not very much. The chemical markets still very slow, still expecting that to improve slightly due to the vessel situation, that a few new buildings coming into the market. LNG, a little more negative view now than we used to have. We haven't big exposure there, and the exposure we have is into the FSRU, which is the regas side of it, and not the transportation side of it. And on the car side, it's looking pretty okay. Wilhelmsen reported a couple of days ago, good numbers, and the outlook is pretty good. We put a little question mark on 13, but it's going to be solid compared to other shipping.
Rune, you just returned to Oslo from a trip to Tokyo and Beijing, where you met with companies and got sort of the latest input on the world's shipping markets. What would you say would be your main takeaways from the trip?
Yeah, it's very important markets to visit, because some of the world's largest shipping companies are located in Tokyo, and of course China is very important for the demand side of seaborne transportation. The mood in Japan is not very good. It is still very weak on tanker and dry cargo, as I said, and we just got that confirmed. And on the LNG side, we changed our view on the more negative side due to the Japanese LNG and gas companies now well covered on the transportation side this year and basically also for next year. And new capacity is coming in from the shipping side, new ships, and there's not very much new capacity added to the LNG side as a new LNG in the market. So turn a little more negative on that side. In China, we saw a more bullish views, but it's not going to be enough to keep up for tanker and LNG dry cargo, we think. But they are aiming at a more sustainable growth, probably lower than we have seen, but it's going to eventually be good for shipping. And they will also be more market driven than we first expected maybe, and they will allow some yards to go bankrupt. That's quite sure.
We are closing into year end, and this time of the year, the big oil companies of the world are making their E&P budgets for the coming year. Naturally, this is very important, crucially important for the oil services sector. What do we know so far, Rune, and what are your thoughts about the outlook for next year?
Yeah. The budgets are not out yet, and the major surveys are coming usually in December and early January. But we saw third quarter reports from all these companies now recently, and the comments are a little negative on the onshore market, but pretty solid on the offshore market. On the onshore side, it's probably that they're going to buy less acreage than they have done in so far and consolidate a little more. On the offshore side, it looks strong. The only negative side we can see there is Petrobras and the Brazilian market, because they are now experiencing a very huge cost inflation on the oil service side, and very much due to local content. And their production is lower than expected, and which means that revenues are lower. So they have to reduce activity. But except that, we don't expect any negative revision on the offshore side. So we still believe in growth in oil service E&P spending of about 10% for 2013 compared to 12. So in total for Navigator, it looks solid on the oil service side. Not very much has changed on the shipping side, and we still remains heavily underweighted and focus on industrial shipping.